Hi, Lynn.
How's it going?
Good to see you in person again. I didn't enjoy that last one.
Didn't think.
We did a remote one.
Oh, that's right. Yeah.
Hated it. I mean, I love always talking to you, but
Yeah.
after it's like, Daddy,
No more remote.
no more remote shows. We just accept it if we can't do it.
Well, what are you going to talk about this time? It's a slow news week.
Not much has happened this week.
yeah.
So, I mean, I was at a conference. I didn't pay attention to anything. Well, there was some big news today in the football space. But no, I think we need to talk about FTX and everything blowing up, what it means, why it happened. I think there's going to be, well, firstly, there's going to be some people damaged by this, and we need to talk about that and talk about what we can learn from this and how things improve in the future. But also, I think some people want to understand what happened, why it happened, how it happened. There's a lot to take in. How have you been taking the whole weekend?
Well, mostly it's a big news week, and it's challenging because we're at the Pacific Bitcoin Conference.
Yep.
Which was awesome, by the way. I'll give that a plug. But
You making an excuse ahead of time?
Well, no, I'm just saying we're at this conference all the time. They were following this crazy news event, and basically, the funny thing is how rapidly it changes. I mean, if we had this interview a few hours ago, we talked about some different things. I mean, basically, hour after hour, day after day, new crazy details and events keep happening. But the short answer is it appears to be massive fraud. I think one thing we can do ahead of time is to say everything is alleged or appears to be, because obviously the lawyers have to go through this, in detail. But obvious scams are obvious now that the documents are out, now that, things are less opaque than they were before. And basically it's like you have this offshore exchange that had inappropriate connections with their trading arm. And we're using, appear to be using customer funds to finance their trading, and we're using their own token created out of thin air as collateral for loans. Okay. And so we appear to have actual fraud, various types of fraud, essentially a Ponzi scheme. And that's different from even just a normal casino, right? I mean, if you can have a crypto casino and it makes money from fees, and most traders get wrecked. But this is like a casino built on top of a Ponzi. So this is like, among the worst of the worst.
Yeah, I can't figure out if this is it's definitely a scam. I can't figure out if it's a scam whereby they set out on purpose to scam and defraud people to personally walk away with a huge amount of money, hide a huge amount of money, or it's a situation that's become a scam because something's got out of control. They've tried to grow a business too quickly. They've tried to use very strange kind of financing methods. And in doing so, they've got themselves into a sticky situation and tried to dig themselves out of it by doing some kind of weird financial engineering. It feels like the latter. I know maybe it doesn't matter. Maybe it's a scam, whatever. But it feels like it's something that got out of control.
Yeah, I certainly don't think they intended to blow up, especially by being so cozy with regulators and politicians and public. A lot of that was clearly like legal defense. And I think the way we can look at it is, because now there's leaked documents of what they kind of pitched to investors. Some of those documents were sketchy, like, earned high returns with no risk, and it's like bolded. And they're explaining why there's virtually no risk for these high returns, which is a giant red flag.
What were they saying? Because were they basing the business on trading fees, though?
Yeah, they're basically saying, well, in the beginning, it was Alameda.
Yeah.
And they're basically saying that, our trading algorithms are so good and we can make money in both market directions as a market maker. And therefore, if you loan us money at 15% annually, there's almost no risk. That was some of the early documents. Okay. They're now surfacing. So from the beginning, there was red flags. And not all those documents were publicly knowable, right? They were, to VCs and financiers and things like that. And so it started out as that trading arm. And then that was like 2018. And then 2019, they launched FTX, which is the exchange. And it appears that a large purpose of the exchange was essentially to provide low-cost capital to Alameda, which are supposed to be separate entities. But it's clear now that they were... And it was kind of understood all along by a lot of traders and observers that there's some sort of probably uncouth connections between the two. But this, as more details come out, you see how intertwined they appear to be, and how kind of FTX was really almost like a way, like a mechanism to extend Alameda and their trading activities and their leveraging.
So Alameda was the trading arm that existed prior to FTX.
Yes.
Do we know when they were established?
I believe 2018.
2018. And do we know much about their trading record up until that point? They were generally held in high regard, or do we now have suspicions that it was never making any money?
I mean, I assume they probably were making money, but it's now unclear. I mean,
Yeah.
if you can't trust the books, then it becomes kind of speculation. And of course, there are people that might have followed they made it their whole thing, almost like private investigators to follow exactly. But I think from early on, they had some sophisticated trading that can work temporarily. But, especially once you start printing your own token and then leveraging that token, you start building a more and more fragile Ponzi. So I think it very much got out of hand, but there were red flags in those documents from the beginning, at least for those who had the access to see those documents, which were not very public documents.
Right. I think Alameda started as a market maker and then became directional at some point in like 2021, and from what I can see.
But market makers make money whatever
That's meant
direction.
to be completely neutral, yeah.
Yeah, completely neutral. So you just make a very small part on every trade.
Mm-hmm.
But you still have to manage your risk appropriately because you can get caught off with a one-sided position if things change rapidly. You take near-term, sometimes one-directional bets while you're making those markets, even if you're not structurally trying to make a long-term bet.
And the rumor is the 8 billion hole?
It's more than that now. So in their bankruptcy document, I think they tick the box between 10 and 50.
For Alameda or FTX?
They're all wound up together. Am I right in that, Lyn? Are they all wound up together?
It keeps changing, but yes, multiple entities have now filed bankruptcy.
I think it's like 132 entities or something.
Yeah, including FTX US, which was, again, supposed to be separate and regulated differently. During this, as this was playing out in many now deleted tweets, first they're saying funds are safe, and then they were kind of admitting that funds were not safe. They were like, well, FTX is still safe, but then even FTX US is doing bankruptcy. So, kind of across entities. It's all intertwined, and there's actually shots of their organizational chart, and it's an absolute mess if you look at it. It's
I'll
have a look.
It's almost purposely obfuscated the way it looks.
So, do we know what the chain of events are what the speculation is on the chain of events that led to the collapse? Because the collapse was the speed of the collapse from something that was 2 weeks ago. Maybe we had no idea. Maybe there was some suspicions, but. Valued at $32 billion, FTX.
Is this it?
Yeah, there's the organizational chart.
I don't even know how you look at that.
Yeah, well, actually, okay.
Imagine keeping track of that.
Do you know what that reminds me of? That reminds me of Vitalik's Ethereum roadmap.
More or less.
Yeah. So hold on, what are all these fucking companies?
He had exposure to over 100 companies.
Westphal,
Various
Alameda
investments.
Research, North Wireless Dimension. What the hell? Alameda Research Cake. I mean, I can't even read most of it. I kind of want to. Yeah, I can't read that, Danny. I want to get dug in. I want to dig into that and find out what it is. But why have they got that many companies?
I think there was a lot of. They had to domicile in lots of different locations and that kind of stuff. So a lot of them were sort of like Alameda US, Alameda wherever else. But I don't know the answer to why.
They also apparently did a lot of venture stuff, right? And they're going to find out which one of those are maybe real venture versus which ones are kind of shell companies. I mean, this is all, again, it's changing hour by hour. This could, some of this will probably be obsolete by the time this publishes, because that's how fast moving this all
Do
is.
a Twitter search, see what the latest thing in the last hour. Yeah. I mean, the last thing I just saw, like I said they've got 0 Bitcoin on the balance sheet, but they got 1.3 billion in liabilities.
Mm-hmm.
But they did also
1.4
billion in Bitcoin liabilities, which means, what does that compare to Mt. Gox? That's like about 3 times. Was Mt. Gox about 400 million when it? I think about 400 million. I could be wrong. But I also read there's 16,000 wrapped Bitcoin that now can't be accessed.
Yeah, on Solana. They're and also wrapped Ether, I think. But yeah, there's some wrapped entities. The problem, a big challenge with DeFi as it exists now, is it is very reliant on, ironically, custodial entities. So you have custodial stablecoins, and you have custodial, wrapped Bitcoin, wrapped whatever. And then you'll have these protocols that, decentralized exchanges and pseudo decentralized liquidity leveraging providers. But the core of the system is often still these custodial assets. And so if FTX holds the keys to these wrapped, Bitcoin in wrapped around, wrapped by Solana, if they lose the keys, then that's a useless token. And so they're currently trading at a major discount, based on the non-zero chance that among these bankruptcy proceedings, someone will find the keys and it'll be opened. But at the current time, it's a problem.
So I was trying to understand. Did you find that Mt. Gox number?
No, I'm not.
All right.
There's also, I mean, one of the recent news is there's a hack. So someone hacked it,
600 million.
Yeah, I mean, I've seen the number keeps changing. That was the first number I saw. Then someone said over $1 billion, and that, well, it could be all different by.
It's a crazy story.
Yeah.
I saw that, and immediately also saw that Sam was on his private jet flying to Argentina. I was like, is he going to LeBitConf?
Well, and then that was countered, and people said no, we still see him on the Bahamas, and so again, this could be different. We'll probably know where he is in a couple of days, but I've seen competing rumors on social media, so I wouldn't speculate on that personally. But.
So the weird thing about FTX is I thought they were just a very successful business. I remember when Binance kind of came out of nowhere and very quickly became a huge exchange that almost every trader I know was using it. Traders didn't tend to use Coinbase, and some use Kraken and Gemini. That tend to be more like retail spot buyers. But it felt like FTX came very quickly out the gates, and they were able to spin up new markets very quickly. I've never have you used it?
No,
I've never used it, but I was aware they constantly spun up these new markets, these new futures markets, and it seemed to me like they understood traders, and a lot of people I know used it. So I was like, when I saw that, and then I saw they had like Tom Brady, I was like, okay, this is just a successful business that is making a lot of money on trading fees. And so I don't understand, because my assumption is they probably were doing quite well to begin with. Probably has some good user sign-up numbers, some good trading numbers, probably some good numbers to raise funds and grow a business. I don't understand where it's gone wrong. Has it gone wrong because they've tried to protect Alameda? Or has it gone wrong because I don't know where it's gone wrong?
It appears to be, yes. They probably try to protect Alameda. That's at least the current evidence I've seen.
Right.
But if we kind of back up to how we got here. So, touching back on the macro for a second, because a lot of these things start with macro. You have rising liquidity environments and you have falling liquidity environments. And most of these, let's say all these, Bitcoin and altcoin like booms that happen, because they happen generally at the same time. When you have a rise in liquidity environment, that's where they've all occurred. They've all occurred when money's flowing, money's cheap, risk assets in general are doing well. And then when that rolls over, the economy's slowing, Federal Reserve's tightening, there's various reasons why this can happen. And you have this like declining liquidity environment. All these Ponzi's break. And then even Bitcoin takes a price hit as capital goes out and euphoria goes away. And the difference is, Bitcoin's been through 4 of these, and it, keeps making higher highs and higher lows, at least so far, And other ones go through 1 or 2 cycles, and then they're just, they're dead in Bitcoin terms pretty much forever. That's historically what's happened with thousands of these projects. And so we've, ever since, roughly mid-2021, we've been in a declining liquidity environment. And it really accelerated here in 2022. And so all these speculations, all these risk-on things start pulling out. And then when that gets pressured, you find out who's, to quote Warren Buffett, swimming naked. Who's more levered in an opaque way than maybe market would have thought. And so, for example, there were a bunch of us pointing out Luna and Terra, that intertwined system, as a gigantic vulnerability. And I wrote about that a lot. That was the good thing about that, among the terrible things, is that it was transparent. And so you could be like, no, this is we can map this out. This is a problem. And a bunch of people did. Then you have Celsius, which was well known as being sketchy for a long time. And there were a lot of people kind of calling that out. It's a little bit more opaque, obviously, than something like Luna, but it was pretty well telegraphed. The one so when Luna goes down, all these things fall. Celsius is heavily reliant on their token. That's getting pressured. And then the surprise to a lot of people was 3 Arrows Capital, because that was more opaque. And they were considered smart money. And they went down, and that hurt a lot of lenders. And you had contagion in the whole industry. All this intertwined leverage was more intertwined than people thought, because again, a lot of it's opaque. And then you had, FTX and Alameda come in and provide liquidity to some of these. And I think a lot of people rightly pointed out that, he was positioning it like, oh, I want to save the industry, I want to be altruistic, but really he's intertwined with them too. And so they want to mitigate contagion so it doesn't bring them down. But then the question is, how, people obviously, again, because of opaque balance sheets, you couldn't be sure how deep their pockets are. Are they like on the verge of solvency, or are they just, they medium, or are they as deep as they claim, right? And so a lot of people, I think, rightly pointed out that they're probably doing this to save themselves. And so there was like this, this kind of lull in the market, whereas not making new lows. There's no more blowups, or at least big blowups. And then it was leaked that what their balance sheet looked like. Alameda's balance sheet.
Yeah.
I think CoinDesk had a
Yeah.
report on that. And what it showed was that a lot of so you have assets and you have liabilities. And of course, the difference between those is your actual equity. And the problem was that a lot of their assets were basically make-believe. There are these illiquid tokens where their own token, the FTX token, they can print billions of it, give themselves most of it, sell a little bit to the market, and have that trade and have like a quote unquote trading price that they can probably manipulate on their own exchange to some degree. Sam would post his own like buys of his own token every week, almost like encouraging retail to keep buying.
It's so obvious in hindsight.
So once that leaked, I mean, a lot of people were like, "This is a giant red flag," because not only that, if that equity if they ever had to sell that, they would not be able to, because once you start selling, 100 million of that, the price is now so crushed. Good luck offloading the other billions. So you don't really have the value that you claim you do. And then they also held other tokens that they didn't control, but they were just they were fluff, right? They're just fluff. Many of them were down significantly. And so people were like, wait a second, if this is their actual balance sheet, it's like, well, how can you verify? Do they have another balance sheet? And, so people could still not be 100% sure, but that was like basically a major vulnerability was now pretty clear. And that's when a lot of people started analyzing that a lot more. And then, Binance comes in because they held some of those FTX tokens.
Was it like 400 million, 500 million?
Something like 500 million.
Yeah.
How did they get those tokens?
They had previously invested in FTX.
I think they were one of the very early investors.
Yeah.
So they backed FTX, and therefore they
In
had
exchange for the token.
Yeah. Okay.
And then so they started selling their tokens with CZ coming out and saying, like just for prudence, we're going to sell these. We don't want to repeat a Luna. Like, simultaneously adding to selling pressure while also using language to show that you're concerned about it and show risk, which makes other people pile on, shorts pile on, other people sell. And then Alameda came out, the CEO, and she said, we'll buy all those tokens from you at $22.
Is that Caroline?
Yes.
Yeah.
By the way, I'd never heard of her until I saw her up on Twitter, and I thought it was a child.
She's a young woman.
Yeah, but she looked very young and very inexperienced.
Their team's pretty young, yeah.
Yeah, but for very inexperienced to be running that size of a book.
Yeah.
I mean,
Yes.
yeah, and saying some pretty crazy things.
So and that's another red flag when you go on Twitter and say, we'll buy it all at 22, because you could have done that privately.
Yeah.
If you want to do an OTC transaction, you can do that privately. To put it out publicly shows you're trying to like build confidence. And that was kind of a major technical support level. There was kind of nothing but air below 22. So now that becomes the line in the sand. And once that, obviously the shorts pile on, once that broke through 22, started crashing, that's when it's all messed up now, because if, going back to that balance sheet, when your equities are like entirely made up of like these make-believe tokens with no real liquidity, if they go down, you're done.
That's like your happened. McDonald's analogy that we spoke about at the conference.
Yes, and then you're insolvent, and then so that's the Ponzi part. But then when you actually, after obviously the post-mortem, people are diving in. They're saying, okay, well, FTX had a backdoor to Alameda. They were, they're lending customer deposits to Alameda, and so FTX customers at risk. It's not just Alameda going down, and they basically showed how bad it all was. So there are a lot of people that knew it was bad, but basically it's like as bad as you thought it might be, or were concerned it might be, it was worse than that. It was just outright worse.
So the big hole in Alameda's balance sheet is basically because they were shit at trading.
Well, I think there's some speculation that they were more heavily hit by like the Luna stuff than they have been public about.
Okay, so they could have been hit quite heavily by Luna. What was the size of the Luna?
I think that was tens of billions of dollars.
Tens of billions. Okay, so they were hit by that, potentially, to whatever number. But potentially it's similar to Three Arrows, maybe over-leveraged. It seems like a lot of these funds were massively leveraged. It's almost like everyone thought we were going to 100, 150,000, and when we didn't, they've all kind of got blown up by this.
Yep, and that's also, it's like, how do you get so big so fast? Well, print your own token and then leverage against it.
Yeah.
That's how you do it. But of course, it's a super fragile, fraudulent model, essentially. So if that tide ever goes out, as fast as you came up, you're now vulnerable just as fast on the downside.
Yes.
And another thing we're touching on is that in addition to raising capital all those ways, they raised FTX raised traditional VC capital, something like $2 billion, through multiple rounds, up to a $32 billion company valuation. And it included like absolute blue chip investors, Sequoia, Sequoia, one of Singapore's two essentially sovereign wealth funds, basically state-owned investment corporations, Canadian pension funds, Paradigm. So these major pools of capital, and a lot of times that industry works circular. They're like, well, if Sequoia did it,
we want in.
And then of course there's documents. There was this was going viral that Sequoia had written about them, and it was a rather embarrassing document. They were basically fully just embracing the personality that was being cultivated and clearly didn't do the due diligence they should have. And when you're investing that much, you have a lot more capability to do deep due diligence,
of course,
than people just on the sidelines looking at this opaque situation and saying, yeah, it looks sketchy, but you don't know how sketchy it is until you actually look at the finances.
Can you see how much Sequoia are in for?
It was about 200 million, I think.
Something like that.
It's 200 million.
Yeah.
It's incredible that you can invest 200 million without performing proper due diligence.
That's the thing. And it's one of those things where that's actually a small percentage of their money. So it's not like they're wrecked or anything, but it's reputational damage because startups fail all the time, right? So there's no shame in investing in a startup that doesn't work out. That's the whole point. You're investing in experimental technologies. What is embarrassing is to get this far, a $32 billion valuation company, and it's basically an offshore casino built on a Ponzi scheme that it also just seems to have outright fraud in it, and just clear lack of due diligence oversight from the people that had the money to have access to the documents. And then there are other VCs that came out and basically said that, they were in talks to potentially invest. And when they asked for more information, they were told like, no. So they would then say, well, we can't then, whereas other ones clearly went through with it. They just said, we believe you.
It's a wonder why they didn't just let Alameda fold. Why go to, because it's very clear that multiple people are at risk of going to jail.
Yes.
Not just for a few years, potentially decades. We talked about, with Preston earlier, we talked about with Bernie Madoff, the 150-year sentence for 68 billion, I think, that size of that Ponzi. I mean, I don't know what this is, 10, 20, 30.
If you lose rich people's money, that's when you're generally going to jail for a long time, usually.
And I don't know if it's 150 years because it's 68 billion. I don't know if the amount of money affects the time, but you have to be aware if you're involved at this level of crime, you're potentially facing a number of years, maybe decades in jail.
Yes.
But could they not just let Alameda fold? Just, okay, it's failed. Would that have taken FTX down with it?
It seems like it again, there's going to be a lot of postmortems on this because we can't even fully trust the books we see yet because this is all recent. But the problem is that Alameda held a lot of the FTX token. And so that would have all been liquidated anyway. So FTX's token would have been just wiped out.
Right.
So it's unlikely you can completely nuke one without the other. But obviously the legal risk is when FTX goes down because that's when all your customer deposits, especially if you've been rehypothecating and re-leveraging them, that's when they're at risk.
Do you think, did they get away with a lot of this because they were based out in the Bahamas? Is it too opaque?
Oh, yes. I mean, they're obviously doing jurisdictional shopping. And that's so they were not regulated to the same degree that they would in the U.S. And that doesn't mean that U.S. regulations are perfect. I mean, I'd be the first to be critical of some of these big altcoin casinos that are onshore. But generally, what you won't see is like a casino built on a Ponzi, at least. So offshore, when you're shopping for jurisdiction, you can basically pick a jurisdiction that's just not going to really look into you that much, and they're just like happy to have you there, and they get some revenue out of it. And look the other way.
God. So what, in terms of looking at this, in terms of the rest of the Bitcoin market, the crypto market, when you looked at, say, when they bailed out BlockFi and Voyager, that to you is them just trying to delay things because they would have been caught up in the same contagion?
Well, back then their balance sheet wasn't fully, known to the public yet, the way it was after the leak, which was pretty recent. So I think clearly they didn't want more and more liquidations going on. And each of these lenders had different levels of problems. So for example, some of the dumbest lenders were outright insolvent.
Yes.
Whereas other ones were more careful with their lending practices. So they weren't necessarily insolvent, but they were not liquid enough to withstand the sheer amount of bank runs that they were having. So
So Zach said at BlockFi when we spoke to him, he said their main issue was duration matching.
yes,
that's
essentially liquidity. If that's correct, that's essentially a liquidity problem.
Yeah.
So that's why they were one of the ones to go. They were able to get through that summer event because they were not as Voyager, for example, if I remember correctly, they did an uncollateralized loan.
Yeah, 650 million.
Whereas BlockFi, for example, was least collateralized. So it's a difference between a solvency risk is worse than a liquidity risk. Both are not great, but obviously, liquidity means you can eventually, potentially, make everything whole again. Whereas solvency is a major problem. So if you're having a liquidity problem, but you're solvent, you can sometimes get a loan that will then make you more liquid. And so you can avoid that whole freezing withdrawal thing. And so so basically the weakest and dumbest lenders went down first. And then the ones that had some degree of better risk management in place, they're the ones they were able to get through it. But if the industry itself is so intertwined and so bad, it can bring everything down.
Well, that's another thing. It feels like everyone was lending everyone else money.
Yes.
Throughout the system.
Pretty much.
And I guess this is how you get the contagion, right?
Yes.
You pull one. Yeah. Danny, in terms of BlockFi, we know they got a line of credit which would enable them to be able to deal with their liquidity issue.
Yeah.
But they said they were able to support customer funds, and their issue is purely liquidity. But they have now completely paused withdrawals, and I've heard nothing more from them. Do we know if they kept their customer assets separate, or they went into they became custodied by FTX? Do we know anything about that?
I would only be guessing, but I'm pretty sure they kept their customer assets.
Okay, so I think the issue for BlockFi is they just don't have that line of credit to call on anymore.
I think they then lent a lot of money to Alameda afterwards.
Who BlockFi did?
I believe I'm not 100% sure, but I think so.
Fuck's sake! All right. Have you looked much into the political aspect of this? We've seen that Sam was become a big donor to the Democrat Party.
Yeah, one of the biggest in the country.
$40 million. Was he the sixth?
Well, that was just on the midterms. I think he's actually put more in that.
Has he? Have you seen that chart that's come out? The relationships between him, his father, and Gensler?
No.
Oh my God! I've got to say, look up.
They all have those MIT relationships. So there's a lot of allegations, but yeah, we'll see what comes of it.
What do you make of what was happening here with the support of the Democrat Party, like the lobbying and?
Well, so some of it could be ideological. Other parts could be to he wanted to find a jurisdiction. He wanted to basically get in on being regulated in such a way. I guess as lawyers look through all this, they'll find chats and maybe they'll learn more. But it clearly was a regulatory arbitrage play. He wanted to kind of use regulation against his competition while not having regulators go at him very hard. And that's obviously a strategic play, a sketchy one, but that's what he was doing. And he was, he was able to buy, just politicians. He was able to buy celebrities. He was able to, just basically have good connections with all these regulators. And so it was, it was an emerging threat really on the industry.
It's strange how a lot of people have said there were these red flags now, but they got away with it for so long.
I mean, there were a number of people, a lot of the Bitcoin maxis, if anything, were the ones pretty critical of this.
Actually, Pierre.
Let me pull this.
Pierre called it.
Pierre called it perfectly.
He was very aggressive. Corey was very aggressive on it.
Corey scared, like I said, Corey scares me. I'm like, I got to make sure I got all my ducks in a row with Corey about.
Yeah, this was back in June.
Yeah, that's pretty impressive. Okay, we're just going to read this tweet out for anyone listening. Easiest prediction I'll ever make. 1, fiat brain bozos tried a fractional reserve banking with Bitcoin and get wrecked. 2, SBF fancies himself as a savvy JPM, bails out the bozos. You are here. 3, which only encourages more bad risk taking. SBF needs a bailout, but he can't print a Bitcoin. Oh, that's retweeting the Voyager. This morning we announced a definitive agreement with Alameda Ventures for a $200 million cash USDZ resolver and 15,000 BTC revolver. I mean, he's nailed it.
Yep, really perfect.
Huh. So what do you think is going to come out of this? Because this is terrible, and it's terrible for a bunch of people. It's terrible for the industry. It puts us back. Do you think? Let's talk about the regulatory side of things. Do you think this is going to put a bigger spotlight on us? Well, it already is, to be honest. But how do you think things are going to change? Do you think we're going to become more regulated? I know it's not a popular thing to say around these parts, but is that a good thing?
I think we can start by defining what us is. I think, for example, we don't identify with FTX and that whole contingent. So the way I would look at it is that there's obviously going to be more scrutiny and more, at least, attempts at regulation. We'll see what can get through kind of a divided government at this point. But there's going to be more scrutiny. And, a lot of these are still essentially what they are is unregistered securities. And it kind of hidden in this whole week was the SEC, they won a court case against a token. About it essentially being a security. And it sets pretty significant precedent for anything that had an ICO. Which was obvious for people to look at the Howey test, but it's now a legal precedent that pushes that forward. And so it is, I think there's going to be more securities regulation on exchanges and on issuers. I think that's number one. Bitcoin, though, obviously doesn't pass the Howey test. It's obviously not a security. Gary Gensler's been very clear on that, and it's pretty straightforward. I think the good news for Bitcoin in the near term, in the long term, is that Ponzi's built around Bitcoin that have nothing to do with Bitcoin, but they can kind of affinity scam Bitcoin and get a lot of the media and people in the public to kind of equate them all together. It's good for those to die or you just be impaired and not be as big as they are. That's a good thing. But the risk is that regulators going after that stuff can use that as an opportunity to also kind of, where they can, lump Bitcoin into it.
Right.
So this is obviously not great for Bitcoin in the near term because it's been bad for price, obviously. But I think longer term, it's one of those. This is like a phase that Bitcoin had to go through because these Ponzi's and these altcoins and these seigniorage have to keep dying for capital to find where it should be.
Does it not just push these altcoin projects out of the jurisdiction of the US?
So partially it can do that, but I think multiple jurisdictions now are obviously going to be more scrutiny of it. I mean, these countries jurisdictional shop for a reason. And two, the United States can extend that to, it's got a lot of influence with other countries and can say, if you host this, that's going to be a problem with us, right? So you can extend your net that way. And then, but also it's not just the regulatory front, it's that it kills kind of the reputation among these things, among traders and among institutions and things like that. So the way I've described it is, we've had this 40-year cycle of just like lower and lower interest rates and higher valuations. And then the crescendo was obviously COVID, lockdowns, print a ton of money with zero interest rates. You kind of hit the crescendo of that bubble. I find it, I keep joking, like famous last words, because I find it hard to believe that there'll be a crypto bubble bigger than the one we just saw because there's so many macro factors together. And then you can't imagine that the regulatory framework's not going to get worse for these types of things. So it's hard to imagine a bigger bubble, but maybe we'll be laughing about that statement in 4 or 5 years, 3 years. But this might have been the high watermark for just the sheer volume and sheer scale of some of these scams and fake seigniorage and things like that.
By the way, I was surprised that Library token was still going. I think that's one of the first shitcoins I bought about 4 or 5 years ago. As I remember, was that the one where it was like a YouTube?
Yeah, it's like a decentralized
YouTube
kind of thing.
But
on the blockchain, bro.
Yeah. But so what is the impact of them losing that case? Were they fined but are still able to operate? Or are they not? They're not allowed. They're only allowed to sell Library tokens to accredited investors. What's the outcome of that?
So I've not dived deep into that, but they have to rethink all of their situation because they're basically blocked from doing what they were doing. But again, I didn't go deep into that one because there's just so much this week.
But traditionally with securities, is it a case of if something is a security, you have to be an accredited investor? Is it that kind of thing?
Well, you don't have to be necessarily an accredited investor, but it means you have to, essentially what securities law is, it's not supposed to really pick what investments have merit. It's meant to enforce proper disclosures.
Okay.
So if a company goes public, it's like, okay, what's the board of directors? Who, how much of the security do all the insiders and investors own? You have to disclose risks, and it has to be able to pass kind of a legal merit. And that's a pretty expensive process. So it sets kind of a threshold, a minimum threshold for you have to be kind of big to go public.
Right.
And so basically by doing unregistered securities, you go around that whole procedure. And so you can have these opaque tokens. You don't fully know the rules. You don't know who owns what. And so that's, I think, what they're going to increasingly be clamping down on. And essentially virtually anything that does an ICO ends up looking a lot like a security. And then if you didn't use the normal security procedures, that's risky. And there's a couple phases there. So some of the ones that got hit early on by using their ICO for American investors. That was like an obvious, that was like the first thing you go against. The second thing you can do is do an ICO, but only for accredited investors or offshore investors. But then you bring the token to an exchange in America or another country that has securities laws, and you can still sell them to retail that way, even though it wasn't the ICO. And that's the part where exchanges are potentially liable.
As sellers of unregistered securities.
For selling unregistered securities.
Yeah.
So there's different layers here where they've clamped down on some more than others. And so that's where we're at.
Okay, so how does this play out? Because will the SEC have to take every single token to court, or to set the precedent, kind of put out a warning to all other tokens that they are potentially securities, and to the exchanges to start to self-regulate? How does this tend to work?
So if you set a big precedent, it generally prevents a lot of big entities from doing it in the future. So for example, if you sue someone for selling an ICO to Americans, all these other ICOs are going to think twice and usually not sell to Americans. They're going to sell offshore. They're going to sell to accredited investors. So that's one. So for example, if you were to sue a large exchange or even a small, just basically, if you were to sue an onshore exchange for selling unregistered securities, it would make the other ones quickly reevaluate the tokens they have on their platform. And the thing that's still in the gray zone is that if a certain thing looks like a security and it's probably a security but hasn't been officially called a security,
it's probably a duck.
Yeah. Well, it's basically, exchange XYZ can say, well, we're selling this asset. We don't know if it's a security or not. I think the biggest counterpoint to the SEC from these exchanges can be, you've given us no clarity on how to even move forward. There's no real kind of mechanism to apply really to like be a security or what you should do. So the government's almost kind of left it purposely unclear and opaque and they've used enforcement to go after these things. And I think I don't want to speak for them, but I think their perspective is like, you have to be proactive. I mean, if it looks like a security, you should assume it's a security. Whereas exchanges almost want to do the opposite, where if it's not like labeled officially as security, they want to almost be like, well, we don't know. It's, we want to sell it anyway. And I think what could complicate it going forward is that these exchanges might have to be registered with both the SEC and the commodities trading regulators.
Right. So the CFTC, because of Bitcoin, and then the SEC because of these securities.
Essentially, yeah. Bitcoin, maybe Litecoin, things that don't necessarily directly pass the Howey test. You could have a small number of commodities or digital commodities, and then a very large number of digital currencies, digital securities, and that could be a market that people play in.
And is this all part of like Gensler's roadmap to get us towards an ETF? Does this all play in as part of it?
Well, I mean, I don't want to speculate on his roadmap, but they keep citing exchanges as their reason.
He wants jurisdiction over them.
I think so. And it does seem to be obviously a jurisdictional battle between the SEC and commodities, but it's also, there's been kind of pushback showing that in the United States, a lot of the price discovery happens with those futures anyway, and those are already regulated. So it's kind of like almost like the SEC's argument there has not necessarily the best merit. But it might be used as like a placeholder while they go after whatever else they're going after here. So it's unclear. And it's also, I mean, he's only got a certain amount of time to do whatever he's going to do, right? So we'll kind of know shortly. And now he's potentially going to be investigated by some of these connections. So I have no clue how that's going to turn out.
Is he?
There have been some Congress people that have been critical of Gensler. And they might pursue something. Now, again, it could be complete without merit.
Yeah.
It could go nowhere. I have no idea. But it's certainly, I think it's probably going to be a more polarized or more challenging environment for them to navigate.
Is there anything else on the regulatory side that we may have to worry about as a result of what's happened here? Is there anything else you've looked at?
So I think the The separate thing is using that to go after things that are unrelated. So someone can be like, well, that's why we have to ban Bitcoin mining. You know what I mean? Something that had nothing to do with it, right?
Yeah.
Especially because, we're also seeing Bitcoin mining bankruptcies, which is, that's got obviously less legal issues because, they did something, they overextended. Most of them are registered securities. These are publicly traded companies. Some of them are private. They messed up or they were hit by the industry. They go down. And then so they can combine that with the energy FUD potentially and say, well, we have to go after Bitcoin too.
Are you even surprised with these miners, the stupidity of some of the ways they've over leveraged themselves by using their equipment as collateral at their highest prices? Or do you blame the miners or do you blame the people providing the capital?
Well, I think it's obviously a new industry, so it's going to be prone to these problems.
Yeah.
I always would generally put it more on the borrower side. They're the ones that are generally are suffering the most from this, and they're the ones that in some cases are going bankrupt because of this. I think like a lot of us, they probably thought that Bitcoin would go higher before this bull market ended. Maybe it wouldn't go as low as it did now. They wouldn't expect rates to be risen to 4% this year. So the macro headwinds I think are a lot harder on them than anyone expected. And then another challenge is that CapEx comes up with a lag. So, China bans mining, hash rate collapses, machines come to the US, building out data centers, and just tons of capital went into ordering ASICs, building things. And that happens with a lag. And so a lot of the, what's challenging for miners right now is that even as the price has collapsed, hash rate is near all-time highs because a lot of that delayed, decisions made a year or two ago are now coming to fruition. And so that's just, it's really rough for all the existing miners, particularly ones with leverage, because if they don't have leverage, they can shut down their highest cost operations. They, it's painful, but they can muddle through. They can pause operations. They can, they all have some degree of, you still pay, you're using real estate, you have some sort of fixed expenses, but if you're a very lean, tight operation, you can get through it. Whereas if you use a substantial amount of leverage, that's when you're super vulnerable.
So do you think we need to be a little bit more toxic Bitcoiners?
I think you definitely want to call out things when you see them. And people have different things they're good at calling out, right? And so I think people should focus on calling out what they're pretty sure is a problem.
What do you think is a problem now? What is left?
I mean,
you can call me out if you want.
No, I'm critical of DeFi in general because I think I think I'm critical about the situation where something claims to be a decentralized commodity and is clearly more like a security where you've raised capital and you promise a roadmap and your developers are then trying to do that roadmap to increase the value of the token, right? So there's obviously a lot of obfuscation around that. I think another thing that has to be keep calling out is that DeFi is not as decentralized as it claims to be because it's heavily based on custodial assets, right? So, you can build a pseudo decentralized DEX, you can build a pseudo decentralized liquidity provider, but if you're using centralized stablecoins that have the option to blacklist, freeze addresses, and you're using, wrapped Bitcoin, for example, they can freeze addresses, they can do KYC, they can lose their keys and go insolvent or, secret leverage themselves. It's like this apparatus of seemingly decentralized activity built around in what is in many cases a centralized foundation, which is obfuscation.
All right, Lyn. Well, listen, that's all very useful, but I can't let you leave without giving us a bit of a macro outlook. Everything seems to have quieted down a bit, and I can't tell if that's because we've been away and we've been distracted. The FTX thing's distracted us. It feels like the scariest headlines, like we've gone through some of the scariest headlines, scariest predictions. But I don't know if I've just not seen it. Like, I know you're looking at this all the time. I haven't read your newsletter this month. I'm really sorry. What's going on?
So there is some good news temporarily in the macro front, which is, but
we're all going to be rich again.
No, we'll see here. So basically, the latest official inflation print came in a little bit below expectations.
Okay.
So
what was
still-
expectations?
I don't have the numbers
All right.
in my head right now.
It came in at 7.7, was it?
Yeah, and it's something like 7.9 or expectation, something
Okay.
on that order. So again, it's like macro nerds that are like, oh, it's 0.2 different than.
So it says here that the consensus was 8% and it came in at 7.7.
Yeah.
Oh, wow.
So yeah,
Scroll up, Danny.
yeah. So you basically have inflation coming down. Actually, you can, if you see on the top there, you can click on like 5 years or something.
Okay.
So basically, what we're seeing is that there's a local high in year-over-year inflation, and it's still at a very high level, but it's now going down rather than up.
Okay. Can you just go a bit long? Can you go 10-year, Danny? 25-year? Max? Oh, so we've had crazy other times.
Yes.
Oh, but I mean, even with what's happening at the moment, the trend.
One thing I'll point out though is that the measurement has changed over time.
Okay.
And if you use some of those older ways of measuring it, this spike would have been on par with some of those, at least those 70s spikes.
Okay. So it could have been 10, 15%.
Yeah, I would say at least low double digits if you measure it the old way.
What's kind of interesting, looking at all these previous spikes, most of them, once they've reversed, they continue to reverse. Do you see what I mean? Like, so anyone's listening, we're looking at the previous spikes of inflation in the 40s, 50s, 70s, 80s. Do you see what I mean, though?
Yes.
Like, once they've reversed course, they continue to reverse course.
Generally, at least for a while until you get another spike. That's the thing.
But what I'm saying is it's on the way up. It doesn't seem to be any times when the inflation's gone up. It's dropped and then carried on going up. They've
Yes.
almost always reversed course.
Yes.
Hopefully. Okay. So do you think we might have peaked on inflation?
Well, and we've actually talked about this in prior
Yeah.
macro discussions where I think we're entering a disinflationary period
Yes.
within a bigger inflationary trend. And
Okay.
using those prior examples, you would see this both the 40s and the 70s had multiple inflation spikes. And I think we're probably going to have something like that happen again.
So we're going to yo-yo around a bit.
I think so.
Maybe I got rid of this too soon. Like
Yes.
here,
Yeah, you had in the 40s, you had 3 different inflation spikes. And then in the 70s and the late 60s, you had, 2 big inflation spikes, and you also had that smaller initial spike. So you basically had 3 big, they kind of come in threes.
And is that
basically.
because you think what will happen is once inflation drops, they will have to reduce interest rates and then they will do more quantitative easing and then we'll see.
I think that's part of it, but I think another big aspect is deglobalization and then especially energy.
Okay.
Right? So we are seeing outright disinflation in things like shipping costs, in some of these supply chain bottlenecks, things like that. What's still sticky is things like labor inflation, which, if anything, it's a good type of inflation. It means wages are going up.
Yeah.
It's only, obviously you want those to go up faster than, say corporate profits, but it's not how it often works. The thing that's still really sticky, obviously, is energy.
Yes.
Europe's got their unique situation, but the more structural problem is that there's been an underinvestment in new energy, both production of oil and gas, like enough production, as well as infrastructure, pipelines, ships, ports, to get that to where it needs to be. And that's something I think that can drive the second wave, along with a shift in monetary policy. When you say enter a recession, for example, weaker dollar, something like that, that can give you the potential of the second wave. So most, like those prior multiple inflation periods, they generally end after you have a significant capex cycle. So in the 70s, for example, they fixed a lot of those issues. Well, at least politically, they ended the oil embargoes, things like that, get the oil flowing again, and then you enter this period where you've done the supply side improvement. So what we're doing now is the Fed is tightening policy, which over time causes some degree of demand destruction. So fewer people buy homes, fewer people sell homes. So some of those people some of the people that work in that industry get fired. Less energy and materials go towards construction. We're seeing a lot of tech layoffs because a lot of these companies, a lot of their growth rates were based on super low interest rates and very high equity valuations. And then you pay the employees very high equity valuations. And so you can keep prices low so you can grow very fast. And now that you actually have a cost of capital, your equities valuation is much lower. And so you actually have to raise prices to pay your employees better, which then means you grow slower, which then results in even lower equity valuations. So you kind of enter a doom loop until you find what is actually not malinvestment.
Yeah.
So we're seeing a lot of tech layoffs.
That's a good thing then.
Yes, but it's but it's rough while it happens. And so that kind of had to be done. But so basically now we're in a slowing economy. with demand destruction. And then we've also had things like, the U.S. government's been selling down their strategic petroleum reserve for likely political reasons. And then you have China has been in this we're going on 3 years now of rolling lockdowns, which reduces their fuel consumption. If you look at the number of flights, for example, it continues to be below baseline, even as some other countries have recovered. So there's all else being equal, there's less fuel usage. And that combination has kept somewhat of a lid on global oil prices. The risk is when you stop drawing down the strategic petroleum reserve, and if you do ease monetary policy, whenever you try to get out of the next recession that we're in, oil's still undersupplied. And that's where I think you get the next inflation spike.
Well, that's the interesting thing is diesel is still $1.90 in the UK. I mean, it's still very expensive.
In the US, so even in the US where we have a much less severe energy problem, we do have diesel shortages. And then specifically our New England area looks a lot like Europe, because what they did was they didn't want to build pipelines. They wanted to go green and all that. They didn't want to build pipelines. We actually some of our biggest gas fields are in the Northeast, right? Everybody thinks of Texas, but for natural gas specifically, out there in like Pennsylvania, we have these really, really big gas fields. It's very close to New England. You can just build a couple short pipelines, and there's a dearth of pipelines that should go from A to B. They don't. And so what happens is in New England, the demand is still there. They still want electricity and they still want heating, right? So what happens instead is they have to buy LNG, which you're taking the same natural gas and you're freezing it and you're shipping it and then unfreezing it. And so it's a way more, it's more expensive. It's more environmentally damaging. And of course, now with Europe trying to buy as much LNG as they can, that puts pressure on global prices. And then there's laws like, I don't think they can even buy their own American LNG. It's like they have to buy someone else, another country's LNG. So that's number one, is they use the same product, but more expensive and less environmentally friendly. And two, they fall back to burning oil for electricity, which is not ideal. It's both dirtier and generally more expensive. And so you end up ironically having a worse environmental impact because you just didn't do the math. You didn't actually have the technology to front run your policy. You tried to front run the technology with policy. And so we're kind of having a mini Europe potential happening in New England, but we'll see. So far, it's not there yet. But the United States does have some diesel shortages and things like that.
Yeah, I tell you, he's a good writer about that, Danny. Is I signed up to Doomberg's email.
Yeah, he covers it great.
Yeah, he's incredible. He was explaining to me all of this, and I was thinking, why isn't there no logic within the policymakers to consider this? But yeah,
I think because it's almost like no one's in charge, right? The people you assume thought this through, no,
they weren't there.
They didn't do. And so everyone's got these short-term election cycles. Everyone's kind of in their own vested interest.
Yeah,
everyone kind of drinks the same Kool-Aid, and of course, there is a difference between actual environmentalism. And sometimes you see environmental policies ironically cause bad environmental outcomes. Like Europe says, okay, biomass is ESG friendly. So then they go and cut down old growth forests and use that wood. And it's like, that is under what context could that possibly be environmentally friendly, right? It's obviously a bad carbon sink. It's bad for biodiversity. It's not the same as like cutting down wood that you can grow trees and then cut them down and keep them. You have this kind of like managed lumber forest. That's different than going out and cutting down just like biodiverse old growth forest. They take a very, very long time to regain that state.
So if you said we've had some good news in that we've had a lower CPI print.
Yes.
Is what comes off the back of that makes things more positive?
So what's come off the back of that is forward expectations of how aggressive the Fed's going to be, like how hawkish they're going to be, have subsided a little bit. Basically that the projections for how high or how quickly they're going to raise rates can start to moderate as long as that inflation print goes down. And then that, by extension, that makes generally the dollar weaker, right? So the dollar's been soaring all year compared to most currencies, not the ruble and the Brazilian real, but compared to most currencies, the dollar's been going very strong. And we've talked about this on prior shows where a lot of countries and international corporations, they'll have dollar-denominated debts.
Yeah.
And if your liabilities are hardening, right, compared to your cash flows, it's a solvency problem. And so a lot of them, then they sell treasuries and that drives up yields higher and you create like a doom loop. And so if you start to get a lower inflation print and lower expectations of forward Fed hawkishness, that can make the dollar then weaken because you have now a lower forward projection of the difference in interest rates between, say, the United States and Europe and Japan, and whatever number that was, say, a week ago is now a little bit lower, and therefore the dollar that was screaming higher can roll over a little bit. The question is how persistent this is. Does that inflation print keep falling for a while? But like I said, the problem is a lot of it's artificial because when people say they don't want inflation, what they generally mean is they want growth that is disinflationary.
Yes.
They want to keep growing without the inflation. That means fixing the supply side. That means having more energy, more cheap energy, better supply chains, better manufacturing, whatever the bottlenecks may be. And in this case, instead, we're going, well, we're not doing anything about the supply side. So we're going to try to rein in demand. So basically, it's like you're causing recession or near recession. We'll see. I think it's by 2023, recession is probably likely, but these things are always not fully clear to quell inflation. So then you have to think ahead and say, okay, what's the second order step? When you're in a recession, what do? Then you loosen a little bit at least. And then the question is, well, if you still haven't made more energy and more energy infrastructure, what's the next step? And I think that's when you get, again.
So we need a more abundance of energy.
Yes. And the other issues that we've had, especially in the past, so in the 80s, China started to open up to the world. And that's basically, there's a lot of capital that, because a lot of the inflation in the 70s, for example, there's a lot of reasons for it. It was demand driven. People were, the baby boomers were buying houses, their first houses. You didn't have a lot of globalization, so it was resulting in wage pressures were building. And then you also had the oil embargo. So you had an energy shortage, labor shortage, and a lot of demand. And one way they kind of broke that, in addition to just, essentially putting the economy through a recession like Volcker, you also turned to globalization. And you said, well, we're going to break all these unions. We're going to suppress these wages. We're going to get Mexican labor. We're going to get Chinese labor. We're going to do all this. And so you basically have a situation where because of various like iron curtains, you had impoverished labor ready to work and you had large pools of capital that want cheap labor. And so for decades, you basically said, okay. And some people benefit, some people get harmed by that. And it depends where you are in the stack, and even in certain countries, you can be hurt or harmed by this. And the problem is we've kind of tapped into all that, right? So once China became a significant rising power, one is their demographics are peaking, so just naturally they're already going to be less able to be at least continue to be a cheap supplier at the same increasing rate they have been. And there's also, of course, geopolitical tensions. And then you had, also part of the globalization was then the fall of Soviet Union in the early 90s. So you had a ramp up in their energy production with more capitalist type of, or at least, crony capitalist, but still basically more competent capital running some of these energy companies, able to increase output significantly. And so Europe benefited from, so the United States benefited from cheap Chinese goods. Europe did too, to a somewhat lesser degree, but then they also benefited from all that cheap Russian energy. And so now with Russia's, production potentially not going to keep going up the rate it has, with their infrastructure now damaged and or shut off, depending on which pipeline you're looking at, they can't just magically snap their fingers and put all that gas in China. So some of that just has trouble until they build more LNG, until they build more pipelines. Europe has to build more pipelines and LNG.
Nuclear.
It's rough. And so all of that is now deglobalization. And so I think we are entering probably a decade, and we've seen now some of it, of periods of either more scarcity or higher prices.
Right.
Sometimes at the same time, sometimes they're almost like a trade-off, where it's like if you try to control prices, then you can get more scarcity. If you don't try to control prices, you might have what you want, but you might have to pay a lot for it. And so I think it's going to be an up and down.
A wild decade.
Yes.
All right. Well, listen, thanks, Lyn.
One more crazy FTX thing that I've just seen.
Danny said it. You said it would happen. Sorry. If you have a bank account linked to FTX US, change your bank account password and stop sharing data immediately. Below is a screenshot of my bank account, which they tried accessing 40 minutes ago. What?
I don't know if that's data or like they're looking for data, but that's wild.
Bank account change your sharing data.
I'm sure that no watchers of this fine podcast would have an account at FTX, would they?
I have no idea. Yes, they will do. They will do, sadly.
I think it's a good time to shout out. Basically, to the extent that you work with counterparties, make sure you trust the counterparties and that they have high integrity. And two, I think it's a good reminder that if you haven't learned how to self-custody your Bitcoin, there's sole custody And then there's also, for example, you can do collaborative multi-sig custody. And there are various ways, depending on how technical you want to get, to self-custody some or all of your Bitcoin.
Lyn, thank you. You're amazing. We're not sure when I'm going to see you next. When are we doing?
We'll find out.
It'll be in the new year sometime.
Yeah.
We'll sort it out.
Thank you.
Yep. Thanks for having me.